So here we are for another year. I'm with my business partner, Michael Sabby, who's our Chief Investment Officer. He heads up our financial planning team, and we're looking at two big things in the 2016 outlook. The first one is the global economy in terms of what's happening there, and then we're going to relate that to the equity market. So thanks for joining us, Michael.
Not a problem, Ben.
So let's start with the US, the biggest economy in the world. How do you read the US economy at the moment?
Look, the US economy is flying along. While some would be questioning that, but I think that the US is actually flying along okay at the moment. A lot of their data points seem to be holding. Obviously, their employment numbers are starting to come down and has been over the last few years. And one of the key things with the US is, or the concern is around the increase in their wages.
Yep.
So that's something that we are keeping an eye on. Inflation's pretty subdued, both in the US and globally.
Yep.
So it gives them a little bit of room. I think last year there was a bit of emphasis and focus on the when the Fed would actually move rates, which they did late last year.
Yep.
This year, the expectation at the time was there would be a couple of rate rises.
Yep.
But given what's going on in the last few weeks, month or so,
Yep.
that's
There was talk around the March, and now they're sort of thinking maybe
Yeah.
mid-year.
Look, they've from the communications, they're still March is still open.
Yep.
But given that they were quite reluctant to increase rates late last year, given the volatility, and that volatility's continued on,
Yep.
I would think that they would be conscious of being wary of that.
Yep.
So where we were expecting 2 to 3, we may actually get maybe just 1 or 2 later in the year,
Yep.
once things settle down a little bit.
Okay. So you were talking about potential wage growth. Tell us what the risk of that is. It's inflationary?
Yeah, look, wage growth is obviously in a services industry or services country, wage is a key input factor of production. So as that grows, one of the good things so far is that the US unemployment GFC time has come from 10% down to 5%,
Yep.
and tracking probably a little bit lower. So it's at the natural employment rate.
Yep.
But on the flip side, we haven't necessarily seen an increase in wages that you would normally see with that type of reduction in unemployment.
Yep.
So which that has been a little bit of concern.
Yep.
They would love to see that come up because obviously higher pay packets, higher spending.
Yeah, that's right. So even though there's a bit of spare capacity, I
That's right,
suppose,
there's
in
a
the
little bit
way
of
in which
capacity.
people have been
Yeah.
employed over
Yeah.
there. Similar to Australia, we've got the same sort of problem around. There's the employment numbers are pretty good, but there's some spare capacity, so people are getting
The capacity
employed
was
for
in,
part-time.
I think the key term is utilisation. you
Yeah.
know, in that headline numbers show that there's a reduction in unemployment,
Yep.
but the type of jobs that are being put on part-time, lower skilled work.
Yep.
So there's an underutilisation of employment. But even that number has started to tick up a little bit as well, which, all else being equal, would lead to some inflation in the wages.
So if we're looking at a sort of score out of 10 in terms of how you see the economy performing for 2016, what would you give it? 6 to 7?
Yeah, look, I'm let's call it 6, closer to that 7 mark.
Yep.
In terms of the economy, I think they would be able to sustain their economy reasonably well to absorb any shocks from China.
Yep.
But it's interesting that a few years ago, the stock market in the US, we were playing and we were advising clients to buy into the US
Yep.
when the economy was looking a little rubbish.
Yeah.
The flip side has now occurred where the economy is actually not doing too badly,
Yep.
but the concern is the stability of the stock price and
Yeah.
the share price.
So the equity market sort of got ahead of the actual real economy, hasn't it?
Yes, that's right. And
Yeah.
that's partly due to the quantitative easing and the increased funds that's available.
Okay, that's interesting. Now, you might be hearing through the microphone a little bit of noise. We've got some renovations going on here in the building, and so we might be picking it up on the microphone, but we'll plough on. So equity markets probably not as good as they've been, and a bit choppier for the US
Look,
market.
I think one of the benefits of, and this year, coming back to the start of this year, probably the last 4 or 5 years, we've seen the equity markets generally have done reasonably well in the first quarter. In part, that is due to the fact that a lot of analysts have downgraded expectations on profits,
Yep.
and the profits actually came above or beat
expectations.
to the expectation.
Yep.
Now, a lot of that profit came from cost cutting as opposed to revenue.
Yep.
Now, so after 5 years of cost cutting, the question is, can the revenue number pick up?
Yep.
Now, if we have a slowdown in China and a possible slowdown in the US, then obviously the revenue comes down, then that's the concern.
So hence we've got really high PE ratios, and the reasons we've got those is because they've sort of come off the high points. The expectation is now that the economy is getting into its next cycle of momentum. We're hoping that the profit numbers raise high, which means that the PE ratios can come up and we see some share price growth.
The PE ratio just before the new year started in the US was running at around about 18.
Yep.
And since the adjustment over the last month, it's actually come off a bit. So, it's approaching closer to the long-term average of around about 15 at the moment. So.
Okay, great. So let's move on because I think we've got a good story there, 6 to 7 for the US economy. Let's go into China.